Hello, everyone. My name is Dominique. We'd like to thank you for coming out virtually this afternoon. We're going to wait a couple of moments or so just to allow everybody to get loaded on their designated computers. Again, for those who just logged on, my name is Dominique. We're going to give a minute or so just to have the attendee list grow and grow. Thank you again for coming. So just bear with us as we wait for the rest of our attendees, and we will get started momentarily. Thank you, everybody.
Well, I will say, like, if I don't leave home with my Yeti in the morning, there's something missing from my life. So you just keep on doing office. Well, I think you told me. In fact, I was kind of I got kind of startled by this. You actually looked at me one day and said, "You mean people pay for these? You don't just get them free from people?" And I got really pissed because I paid for most of them. Yeah, but I've paid for most of them. In fact, that day I forgot one. I went over to what's the sporting goods place over here? Dick's.
Oh, if you would have gotten 10,000 steps, you would have gotten one from us.
I had it, but I paid $30 for this thing. Yeah, I know it was hard. And then, but
we're gonna have to edit out that comment. $30 for a cup. We have like 100 cups in the kitchen.
Okay, well, I need to steal one. Oh, but then I did get these colorful little tops. That was pretty. Yes, very fancy.
All right. We are going to go ahead and get started. Thank you, everybody, for joining. I will pass it over to our panelists, Dave and Andrew.
All right. Thank you very much for joining, everyone. Appreciate you being here today. That was Dominique, who is from our investor relations team. And we also have Natalie King here, who's helping us out with our questions and answers and going through details on the deal. Many of you know her. She's been here quite a while with the Greenleaf team. And then we have Andrew, our managing partner for all of our retail assets. We've got an exciting conversation today. We're going over the DQ Grill and Chill, which is a new purchase for the Triple Net Fund. And we're going to kind of explain how we got to where we're at with this deal, what happened with some of the other deals in the Triple Net Fund, and what the opportunity looks like here. And then ultimately kind of dig into the financials of the deal and exactly what we're seeing. So,
sounds great.
Yeah. Just a quick overview on Greenleaf as a whole. Many of you have been with us for a while, but we're operating in 4 different states. Our main retail deals are in Georgia and South Carolina, and that comprises everything from Zaxby's and Applebee's we just sold, or Dollar Generals that Andrew has put together here over the past 3 years with Greenleaf. And then our apartment and commercial deals, those also go up into North Carolina and Tennessee as well. So quick overview on what happened with Applebee's and how we got to looking at this DQ.
Applebee's was purchased. It was a perfect time. We bought it March. Was it March or was it February?
March of 2020.
I think it was March of 2020. We closed. And for those of you who might not remember, there was something called COVID that happened, and we had a March lockdown. Literally, we closed on this Applebee's just a few weeks before closing. And immediately everybody went into COVID concessions and trying to figure out how to make everybody survive. Applebee's was, of course, closed down for a few weeks, only a few weeks. But we bought it at a really good cap rate. It was backed by a high balance sheet company called Neighborhood Restaurant Partners, which is owned by Oregon Capital. And what we have learned a year into this is that the major brands with balance sheets were the survivors in this business. So Applebee's went from, we don't know what was going to happen, to literally one of our core assets that had a huge increase in value during COVID. So we bought it at a 7.7 cap with a 5-year lease. And then a year later, we had to give them some COVID concessions. So we gave them a little bit of a break on rent. Our mortgage company, of course, gave us a little bit of a break on the mortgage.
We had 3 months.
Yeah, so we got 3 months. We gave them a 3-month break on the mortgage. And then we got a 3-month, we got a 3-month break on our mortgage. They got a 3-month break on rent. In exchange for that, we said, hey, well, what do you want to give us in return? And they gave us a 7-year lease extension. So a 5-year Applebee's versus a 12 or 11-year Applebee's, the 12 or 11-year Applebee's is worth much more. So we were able to sell it a year later, and at 1.2, or I think it was 2.9 million, which basically gave us cash of 1.2 million, 1.3 million. We put about 972,000 into it, and so we had a nice profit. We had almost a $300,000 profit from a year investment, which turned out to be a 25% IRR. So altogether, for a year investment, that's a home run. You know, would you call it a retail home run?
I definitely see that as a retail home run.
Yes,
and we did all of this in the Triple Net Fund. So the cash numbers we're talking about here, this initial investment of $972,000 was done through Triple Net Fund. And
Correct.
now the Triple Net Fund has 1.26 million in available cash from that Applebee's
To
transaction.
buy something else, which
Yeah.
we're going to talk about it now in the next.
Yeah,
And then we also have the gain to talk about a little bit.
Yes.
So what's going to happen
So-
with our existing triple net?
so we sold
investors.
to Applebee's, and yes, we made money, and kind of always that next question is, okay, we made some money now, what are the tax consequences? And we did not do a 1031 exchange with the Applebee's. We did not have the DQ lined up when we did the initial sale of Applebee's, so that normally doesn't work for the 1031. We always like to have something lined up before we tell people what we're doing. Since we didn't have that here, we just went through with a normal sale. So the end result of that is we made roughly $288,000 of capital gains from that Applebee's sale. And those gains flow through to the Triple Net Fund, and then those flow through to each individual pro rata on their K1 that they receive from the Triple Net Fund. Now to counter that, right, so that's a passive gain. The fund itself has passive losses from depreciation. And then also the acquisition of the DQ is going to have passive losses from depreciation and also year one write-offs from closing costs.
And your promise to me has always been, we are going to minimize the taxes as much as possible. So whatever we can write off, we're going to write off to eliminate as much of the passive loss as possible.
Yeah.
So that's what we're going to be working on over
Yeah,
next year.
the taxes flow through equally to investors as general partners. So we were very much in the same boat of trying to maximize our tax efficiency. So when we look at the DQ acquisition, we have about $85,000 in closing costs, and we're gonna go into a lot of the financials behind the DQ. But overall, we'll have about $100,000 in passive losses from the DQ in year one, and the end result is roughly $180,000 of passive gains related to Applebee's and DQ that will flow through from a tax liability standpoint on 2021 taxes.
And then the fund passive losses may or may not be able to
Counter some more.
counter some of them depending on your tax situation.
Correct. Yeah.
So what's next? So we're buying the DQ.
Yes.
We're buying we bought a bunch of Dollar Generals. We're on our third Dollar General now, and Dollar Generals are very exciting to a lot of people. They're very consistent and they're very earners. I love buying them. They're easy and just I don't know what to call them, a bread and butter investment. But this I am really excited about because this is a major brand that we are getting for a good cap rate. We were competing with other 1030. We're not doing a 1031 for this, but we're competing with 1031 buyers. We're competing with mom and pops who have some money to move forward. And so their sophistication level as far as buying an asset like that is not very high.
Yeah.
And so we were picked because we're a professional operator. We know how to buy these type of properties. And the owner, the seller said, look, these guys are going to close. We know it. They're a known risk. And so they actually picked us over someone else. And so the overall equity, and it's going to be just under $900,000. So we've estimated $891,000. So from the $1.26 million from the Applebee sales, $891,000 is going to be taken and put to the DQ.
And that with that remaining cash, there will be distributions to investors to cover not only the tax liability, but a little bit above that as well. So we're going to get a new asset with the DQ here, and we'll also have some distributions. So there'll be no cash outlay on the LP side or
So
GP side too.
Right, so we're not asking for cash, and there's no additional cash that we need for this deal right now because it's 100% funded through our triple net fund one.
Then we're getting a 7.1 cap rate with a 17-year lease.
Yeah, and remember, we're trading from a Applebee's, which is a 6.5 cap rate, and a 12-year lease or 11-year lease, and we're getting a 7.1 cap at a 17-year lease. So great
So,
trade.
yeah, it seems
Great
good.
trade.
And then when we compare this DQ, remember DQ Grill and Chill is not a Dairy Queen, right?
Yes.
There's two kinds. We're going to go into kind of what the difference between a DQ and then a Dairy Queen.
Well, why don't we talk about that next? But so we've had to go through an exercise all around Greenleaf. It's not Dairy Queen. It's not Dairy Queen. It's not Dairy
We had to physically go to all the Dairy Queens and DQ Grill and Chill and try them
Queen.
for lunch every day.
Yes.
But no, but seriously, it's the Dairy Queen brand, obviously it started in 1938. It's a very old and well-known brand. We've got Andrew's buddy there right in the center, Mr. Buffett.
Yeah, so Dave finally gets to go into business with Warren Buffett, so he's very excited about it. Warren Buffett bought the company in what year did he bought the company?
97.
Was it 97?
96.
97.
So,
Yeah.
and then this whole DQ grill and chill concept started in the early 2000s, actually started in Chattanooga. So it's right in our footprint. In this store specific, this is 2008.
The building it's a brand new build, literally it's from the ground up, 2018, a brand new building with a brand new 20-year lease. And so 3 years have burned off of it. But let's go to some DQ fun facts. Ready for some quizzing about DQ?
You love
I love my quizzes. So
he loves to put me on the spot with trivia questions.
What is we'll just back up. What's Dollar General's annual gross?
We know that. That was a 34.
Very good, very good. So that's a big company, but DQ is still pretty big. So what do you think DQ's annual system-wide revenue is? System-wide revenue. So all
not 35 billion.
No, not 35 billion, but it's still, it's big. Can you guess?
5 or 6.
Well, okay, I know you know
billion.
the answer because it's sitting right there. So thank you. But it's 3.7 billion system-wide sales. So it's a pretty big company. It's owned by Warren Buffett's company, Berkshire Hathaway. And what's phenomenal about this brand is that there's 4,300 locations in the US, but not only are there 4,300 locations in the US, 1,400 locations outside the US. And I thought that was pretty remarkable. And so, they're a big brand in the US as well as outside the US too. And with the new concept of DQ Grill and Chill, we may have not explained this well, but Dairy Queen is known for desserts and going there after parties or cakes. DQ Grill and Chill is the next transformation of that business into a business that actually sells additional product. So you can go there, you buy from the grill, and then you have your dessert. You're gonna chill.
Yeah, and you can see it's a newer looking store model too.
And so it's hamburgers, chicken, it's whatever you would see at like a typical QSR restaurant. And so that's the new concept. And there's 1,000 of those right now in the US. And so this is their new concept. And a typical DQ will earn about, I think it's about $1 million a year, I believe, probably a little bit off my numbers, but a DQ Grill and Chill can get up to the $1.5 to $2 million a year in sales. So it's
and it's about 20% of their stores are this DQ Grill and Chill concept.
Okay, here's some trivia though. Don't forget about the trivia because the trivia is the most fun. Who worked for DQ in 2002? Who managed the DQ in 2002? Mark Cuban. Mark Cuban managed the DQ in 2002. Yeah, and
he's come a long way since working at the DQ.
Yes, he's come a
They have
long
a
way.
good
But
management
that could have been
team.
his start. That could have been his start. Mark Cuban's start. So, and you know who invented soft serve ice cream?
I'm gonna go with probably Dairy Queen
Yeah,
not Baskin Robbins.
correct.
That's not what I'm talking about. But
So the whole soft serve ice cream concept was invented by Dairy Queen, which that was something new I learned. So literally, this is a brand that we've seen in malls, we've seen them down the street, but this brand has been around forever, and it's an American brand. I mean, it is.
And this newer format, this DQ, the grill and chill concept, we've looked at other stores. Obviously, when we're buying something, we're comparing it to, hey, what else is out there? Not only this brand of the specific grill and chill, but also Dairy Queen in general. And we look at other stores that are for sale. These aren't direct comps because they're not like in Atlanta in the same area, but they obviously don't put them right on top of each other. But these are two of the other deals that are out there right now, trading at significantly lower cap rates than what we're able to pick them up for.
Right, because we're hoping that we're going to buy this at a 7.1 cap, and we're going to sell it in the 6s, maybe in lower in 6s, or just keep the cash flow, let it appreciate value. So we are buying this transaction at a lower market value than a typical product would trade, a typical like-kind product would trade.
You see the other ones at the 5.3 cap, 5.6 cap. And kind of at the end of the presentation, we get into the investment returns. We'll talk about what it looks like if we were to sell this one at a 5.3 cap, what those returns would be. Our next part here, we're going to dive into the investment overview as a whole. So this deal is in Marietta, Georgia, the Atlanta metro area. It's Cobb County, which is a very, very one of the fast growing counties here around Atlanta. You want to have kind of like our total price here is 2.
Right. So what we're buying for I keep on looking at this. It's a very odd number. We're buying at 2.245183. So somehow we came up with that number for purchase. And so we're buying it basically roughly just under 2.3 million. It's a 3,200 square foot building. It was built brand new from the ground up in 2018. It was a quick trip before, and the quick trip was removed. All the gas tanks were removed. Everything was cleaned up, and then they built the QT. And our current hold time, we always estimate 5 years, but with this one, we never know. This could be a core asset we look at in 5 years and think about.
So we'll see. So we kind of target 5 years to start with, and that's kind of our standard hold period right now.
Want to talk about Marietta a little bit?
Yeah, if we look at Marietta, in general, Greenleaf, we're aiming to buy stuff between Atlanta, Chattanooga, which is up 75. You kind of see in the top right corner here, you see the big 75 highway number. That's the corridor that we look to buy stuff in. And then going east, we're looking up from Atlanta all the way up through Charlotte into Raleigh, which is 85. So here, this deal is right off of 75. It's in Marietta, which is a great suburb of Atlanta. And you see it's on the main road with lots of other stuff that's right around it.
Right. There's a Zaxby's right down the street. There's a local brand called, oh my God, I'm forgetting the brand. It's another QSR brand, but it's literally lined up with, like there's an Arby's down the street. There's a Taco Bell. I mean, this is the trade area. So this restaurant is in line with the trade area. So this street, Powder Spring Street, is the artery from Marietta to Powder Springs. And it's still considered Marietta, believe it or not. And Marietta is the 4th largest growth city in the US. And I think the statistic that we talked about, or there's some Zillow and Yelp call it one of the top 10 most affordable suburbs of the city.
Yeah, we're always trying to, the reason we like 75 and 85 going northbound is just population growth. We're trying to find assets that are in areas that are growing and have more consumption in those areas and more growth.
Oh, and don't forget about the good schools too. So if you move
if you're in Atlanta, Cobb County has some of the best schools.
A lot of people, they purposely live in Cobb County or Gwinnett because the schools, and they just commute south because they just, the environment's, your house is bigger, your lot's bigger, and a little bit more affordable.
Typical kind of suburban answers.
Yes.
From an investment overview standpoint, since this is being done in the triple net fund, kind of the bottom left there, we went through some of the acquisition stuff, but the returns and fee structure, this is the same preferred return, the same profit sharing splits and fees that we've had since day one in the triple net fund. Obviously, we're buying it at a cap rate that's slightly above our preferred return, so we'll beat that a little bit out of the gates.
Right. I think year one is 6.8%. So 6.8% will be in the pocket, and we also have we have 4 properties in this fund, so it'll be combined with the other properties too.
Yeah.
But
this one adds positive cash flow too.
Yes, this is going to be a net positive to the fund. So, and then in year 5, if just based on cash invested, it needs to be a 13% return. So a 13% return on cash, I would take that.
Yeah,
I would take that.
We think it's pretty good. That's why we're doing this one. Yeah. We're going to dive into just what the cash flows look like. So we mentioned year 5, but between year 1 and year 5, that's again, the thing was built in 2018. So we're really, for us, it's year 1. For the deal, it's year 3. So then 2.5 years from now-ish is when they have their first rent bump that will come in. So if you look year 1, year 2, year 3, you see then it kicks up to $76,000 per year in cash flow, and obviously makes our returns go up from that standpoint.
And the exit sensitivity table, if you look at the bottom, so we just estimated a conservative exit in 5 years at 6.5 cap. Overall, the deal is going to earn about 14 to 15%. However, if the market stays like it is right now, and we're able to sell in the 5s. Your returns then going into the 17 to 20%, 17 to 21% range if you get to the 6 or the 5.5 cap range.
Yeah, and what happens there, one, we're getting a lower cap rate, but also we're selling at a lower cap rate with higher revenue from once these rent bumps take in place, and they're every 5 years going out. So we'll have another one if we were not to sell it in year 5, obviously there's another one 4 years.
Well, the landmarks are always the rent bump. So we'll have a rent bump around year 3, and we'll also have a rent bump around year 8. So those are the landmarks.
Yeah.
Milestones, maybe not landmarks.
Yeah. Least milestones.
Least milestones. Okay.
Yes.
Yes.
Okay, so that's the general overview on cash flows. And again, this will be lumped into the fund as a whole. So your cash flows at the end of the quarter are not necessarily like you're getting something specifically from the DQ. You'd be getting it from the triple net fund as a whole with our equity base and having that distribution each quarter.
Okay, don't forget about the fun thing.
Yeah, the occasional in-person event. So we're going to turn over to Dominique, but we're pretty excited about doing something in person as well as not only the video webinars.
Yes.
So we'll turn over to Dominique. She'll kind of tell you what we're looking at doing next.
Thanks, guys. So we are super excited about the DQ Grill and Chill. So we want to invite all of our local investors to come on out and celebrate with us. You can RSVP you can reference the email invitation that we sent out to you earlier. That also included the webinar information. You click that link and you can go ahead and RSVP with us. Again, these webinars are really to answer any questions that you guys may have in regards to the deal as a whole, maybe details, property specific details, anything that maybe come to mind that you would like more answers to. So before I begin, this is a friendly reminder for you to submit any last minute questions. We've had a couple come through, which we're really excited to dive into. So I also wanted to provide clarity. This is part of the presentation where I would talk about next steps, funding timelines, things of that nature. Lucky for you guys, this is a reminder that there are any additional cash or capital required for this asset and for this acquisition, nor are there any additional documentation, subscription agreements needed for this purchase as well. Your new investment amount correlated into the triple net fund with DQ Grill and Chill will be reflected in your investor portal, so you can always check that out. And you can expect a distribution of those proceeds that Dave and Andrew spoke about by the end of June or so. So again, please, this concludes our regularly scheduled program. So if you need to log off for whatever reason, we thank you for joining us today. And you should receive an email from us by the end of the business day tomorrow with this webinar and the recording link for your access. With that being said, I'm going to pass it over to Natalie, and we will go ahead and dive into the Q&A portion of this broadcast. Thanks, everyone.
Thank you, Dominique, and thank you to all of you who submitted questions. We had quite a few come through, so if we aren't able to make it through all of the questions, don't worry, we'll be sure to follow up with you after our webinar. So let's get started. So our first question is, can you please provide an update on the other Triple Net Fund 1 properties?
Yes.
Yeah, we could. So the first property we purchased was actually the Zaxby's. The Zaxby's continues to do phenomenal during COVID.
They're paying, everything's on track there.
Yeah, in fact, last year we did make the offer to give every single one of our restaurant tenants a concession. And I basically asked the Zaxby's person, he said, you know what, Andrew, I just don't need it. And so literally I have to get his final sales numbers, but 2020, his sales might actually be better than 2019. So he's doing.
And then O'Charlie's was another one we purchased, and that's similar to the Applebee's, was a dine-in restaurant.
Right.
They did get their concession.
Right.
Instead of doing a lease extension, though, they've been paying back that concession. So we went from 15,000 or so a month in rent to 17,000.
So 2020 for O'Charlie's is going to look really nice.
Yeah, that one's going to be very good.
Because we're getting 3 months extra rent this year. Yeah, 3 months extra rent this year. Yeah.
And then the other deal we had was Andrew spoke about the balance sheet tenants and organizations that actually have some backing to them. The other deal we had was 330 Edgewood, formerly known as Black Sheep.
Yes.
So that restaurant did not work out during COVID.
The tenant did not
work
great
out.
Location, great place.
But so we got that tenant out, which was a feat in itself during the kind of eviction moratorium, and we actually released it to another tenant. So they opened.
They're opening. In fact, I spoke to him this week, and he's going to hopefully do a soft opening this week. And we went from $13,000 a month rent to $16,000 a month rent on that one. And then our last property was the Applebee's, which we sold.
Yep.
And
now we got the DQ.
And then the fifth one, number 5, will be the DQ.
Great. Well, still on the fund, do you guys plan on adding more properties to Fund 1?
Fund 1, no. So Fund 1 is closed. It's closed to capital, and so we could buy and sell inside the fund, but we're not opening it to capital because then some investors might be diluted. So we're keeping the capital the same. And ideally, every time if we do trade an asset, we'll return capital to our investors, and they still they're going to receive a paycheck on the capital return, and then also their normal quarterly check for their preferred returns. They're on the table. We are talking about maybe there might be a Fund 2. Fund 2 may be a 2022 idea, but
if we can get some consistency in what
we have to have a certain volume of transactions. So we put four properties inside Fund 1, and so we have to have some faith that we're going to be able to have that transaction velocity to put enough property in the fund.
All within a fiscal year.
Right. So a January to a December, because if we don't do it from a January to December, our accountant gets kind of grouchy. because
Yes.
it makes the accounting a lot more complicated. And it makes Natalie's life,
Taxes. Yes.
makes Natalie's life a little bit more complicated too, quite frankly.
So you guys answered 2 questions that we have, but just so that everyone knows, clarifies those answers. So are you allowing any new investors to be part of Fund 1? You said accepting no new capital. So the answer to that is no.
Right.
And then are you going to open a second fund? And then you said possibly, right?
Correct.
Correct.
Great. You mentioned in your end of quarter webinar about cap rate compressions. Can you talk a little bit more about this?
This is a fun one for Dave. I'll let you take this one.
Yeah, well, thanks for watching the end of quarter webinars too. We've been trying to get just more information out on kind of what we're seeing in the market and how things are working. But when we think about cap rate compression as a whole, there's even in the past 18 months, there's been this drive to find yield throughout the market. We get inklings of rates going up, right? And we haven't seen anything consistently that's going to drive up what yields would be. So cap rate compression is happening when anyone sees a business that is stable. So when we look at even this DQ Grill and Chill, trading at a 5.3 cap, you know, that's a lot lower than it was 2 years ago. We're buying one at a 7.1 cap, which is a feat in itself, and just trying to find ones that we can get at that rate. The answer is always in like, oh, hey, why don't they sell for 5.3 cap too? And we don't have a great answer for that. It's not a completely efficient market. So there is value in opportunities to be found.
And your favorite product, the Dollar Generals. We used to be able to find 7 cap Dollar Generals, you know, last year pretty easy, but now 7 cap Dollar Generals are a thing of, I don't want to say a thing of the past, but they're a lot more.
It's harder to find.
Yeah, so we're working on that right now.
And even major brands, if you look at like a Starbucks or a Chick-fil-A or one of those groups, they're getting into the sub 4% cap rate, which is, you can't really buy that with debt.
We saw I think I forwarded this to you, we saw a very rural Dollar Generals, which of course are not our favorite. We actually saw it trading in the 5s, which I thought was just amazing.
Yeah.
So
I hope that helps a little bit on the cap rate part, especially our end of quarter webinars we're going to do at the end of the second quarter too. We'll touch base more on that as a whole of what we're seeing across all of our kind of, you know, different assets, but also just in the retail space for sure.
And our last question reiterates what Dominique mentioned. When will we find out total returns in the fund with the new purchase of DQ, and also when the distributions for the sale of Applebee's will be available?
So total returns.
well, we know the overall project return, and we know
sort of. We still have to kind of finish out all the closing, not the closing of the sale, but the closing of the buy side on the DQ. And once we have all those costs set, takes us then about a week to kind of close down the books and get a full report of like, hey, this is exactly what the profit percentage were and exactly what the dollars are that are going out. And we'll probably have that out in the middle of June. And then once we send that, then the distributions kind of follow with that going towards the end of June, where all the money will leave us and hit all of your accounts for the final distributions. Huge selling point. But no, we're going to try and do something that where we can all get together. Everyone on the Greenleaf side, you know, and investor-wise too. People are excited to be out there and see some people and see what's going on.
Even better, they have an outside patio too, so it'll be a little relief.
There we go. So we look forward to seeing you there. We appreciate you tuning in here and listening to what we have to say about the DQ. We're excited about the opportunity, and thank you very much for watching.
Thanks for joining us.
Well, thanks everyone for submitting your questions. And of course, we also want to thank our hosts, Dave and Andrew, for sharing their insights. And as we wrap this up, just a friendly reminder that the webinar is being recorded and you'll receive a link to the presentation by the end of business tomorrow. So this concludes our webinar, and we certainly appreciate you joining us today. Goodbye.
Bye.
Thanks, everyone.